Okay, sorry about that. So we come to example 5, right? And we come to holding period return, the concept of holding period return. Now, all this time that we spoke of nominal yield, current yield, yield to maturity. Yesterday, we said that these are expected returns. These are returns that we expect to get when we buy a bond, right? What is the actual return we earn? That is what we try to find when we look at holding period returns. What is the actual return we earned, right? So it considers actually what happened to our coupons. Now, one of the biggest problems with yield to maturity is the fact that we assume that these coupons are reinvested at the same rate as yield to maturity. Right? That the coupons are reinvested at the same rate as yield to maturity. But that doesn't necessarily happen. Ideal example is last year when we had yield to maturities of 30% or 25%. The calculation assumes that all coupons are reinvested. When we get a coupon, it is reinvested at the same 25% because it's semi-annual divided by 2. But at 25%, which today we cannot. We can never, when we get a coupon, reinvest that at 25%, right? So the actual reinvestment of coupons will be lower. This can be different. This can be lower, higher, depending on the period that we're looking at. In general, yield to maturity is pretty accurate because even with considering actual reinvestment of coupons, you will see that the variation is smaller, right? But holding period return also considers the fact that if we don't hold this bond until it matures, if we sell the bond in between, what is the return we will get, right? Our trading gains and losses. So it takes into consideration actual reinvestment coupons as well as our trading gains and losses and looks at our total return. So in a holding period return calculation, what we look at is, okay, what is the return what is the period that we actually held this bond for, right? We held this bond for a certain period of time. It could be until maturity. It could be before maturity, right? It could be before maturity. But we held this bond for a certain period of time. Now, within this period, we got certain coupons. And at the end of whatever period that I'm looking at, there is value to my bond, which could be the value that I traded this bond at, or it could be the face value, right? It could be the price that I sold this bond at, or it could be the face value of the bond, depending on whether I'm considering maturity or whether I'm considering a trade market price. So I actually paid for the bond at the beginning of the period. I received coupons in between. And I sold the bond or the bond matured at the end of the period, right? Whatever period that we're talking about. Our assumption is that these coupons, that it's not an assumption when we look at, for calculations, it's an assumption. But in actual world, in practicality, we will look at what is the actual rate we reinvested the coupon at. Yeah. We look at the actual rate we reinvested the coupon at for this up to this period of time, up to the end of the period. So in general, we assume for calculation purposes that we reinvest the coupon at a certain rate and it's compounded at the same rate as the frequency of coupons. So if the coupons were semi-annual, then we assume that there is semi-annual compounding. Or if the frequency of coupons were quarterly, then we assume that there is quarterly compounding, for example. And we look at this coupon. After it was reinvested, how much is it worth at the end of the period? So I call that C1. How much is C1? What is the future value of C1? If this is C2, what is the future value of C2? If we received a coupon at the end of the period, anyway, there is no future value. There is no investing that coupon. We have received it. That's C3. And we have received a price. And I look at all of these and I look at what is the total value that I have made by the end of the period. Okay. What is the total value I have made at the end of the period? At the beginning of the period, I paid for this bond. That's my beginning of the period value. So I have the value at the beginning of the period, I call it present value. And I have the value at the end of the period, I call it future value. Right? All in between cash flows have been assumed to be reinvested and now occur at the end of the period. Right? So therefore, there are no in between cash flows. Because of this is essentially two cash flow problem. I have a beginning cash flow and I have an end cash flow. So I want to know what is the return, effective return over the period that this cash flow earned. Right? This is my holding period return on an annualized basis. I can find my holding period return on a non-annualized basis, or I can find it on an annualized basis. If I was to find my holding period on a return on a non-annualized basis, that is simply what is the return from here to here, right? It doesn't take into account the number of years I held it for, or the period that I held it for. On a non-annualized basis, it is simply right P2 minus P1 divided by 2. P2 minus P1 divided by P1, right? This is P2, P1, and this is P2. It's simply the capital gain, right? On a non-annualized basis, it is simply the capital gain. Okay. Or future value minus present value divided by present value. That is non-annualized return. If I want to annualize my R, to annualize and find it, I can say my return is what? Future value equals present value 1 plus R to the power n. And from this, I can find what is R. It is simply taking this value and compounding it. That's all. Same answer, right? Simply taking this non-annualized value and compounding it. You will get the same answer. So this is your holding period return. Let's try it through a sum and then we'll discuss it again. Okay. So what are you trying to do? You're trying to take the coupons and reinvest it and at the actual return, right? So each coupon, you look at how much is this coupon worth at the end of the period. At the end of the period. Without reinvesting it at yield to maturity, because the assumption on yield to maturity is you reinvest it at the rate at yield to maturity. Here we look at what is the actual rate we will reinvest it, and then look at, okay, what did we earn? Let's try some. So I changed this example number to example number 5 and 6 because we added an example before, right? Okay, read through the sum and see, and draw the cash flow diagram. Can you try part 2 of the sum first? This part you know how to do. Try part 2 first. So to do part 2, you don't need This. This is not there for part 2. Yeah, I'm waiting for yield to maturity. What is guess one? Okay, 59, that looks right. Neeraj, what is R you used? Okay. So it's annual coupon, it's very easy. Target minus 92.8 over a 2-year period. plus 20 divided by 100 plus 20, 92.8 over 2-year average. And I see you're like getting 24.48. So you can use that 24.48 to find P1. Because it's annual coupons. Coupon is 20. So I'm told the answer is 93.5098. Okay, great. Thank you. So you want 92.8. So sure, R2, what do you want to guess? What do you want to guess for R2? A higher rate? Okay. Yes, because 93.5098 has to come down to 92.8. Therefore, R2, okay, you all want to guess 25. Fine. You can guess 25. So you can find P2 based on 25. Oh, it's exactly 92.80. Is that right? Then no further, nothing else to do. If you all guessed it right, meaning 25 is a fair guess, right? You can't guess it to say 94.56 and think that that is a guess, right? But 25 is a fair guess. So if that comes to exactly 92.80, that is your yield to maturity. So nothing further to be done. Is that okay? So you have yield to maturity of 92.80. Sorry, 25%. Right. Yield to maturity of this bond is 25. Now you see, you have purchased a bond that promises you a return of 25. What we're trying to do is figure out, after the actual period has finished, did this bond actually give me a return of 25%? That's what we're trying to figure out by looking at my holding period return, right? So let's look at it. In your holding period return calculations, let's do it step by step, right? You have purchased a 2-year bond at 92.8. So in year 0, your cost is 92.8. in year 1, you receive a coupon. You receive a coupon of, okay, let's see the calculation. Thanks. You receive a coupon of 20 rupees. Because it's a 20% annual coupon, right? So on a 100 rupee face value, it's 20 rupees in year 1. And in year 2, you again receive another coupon of, remember, although I'm talking in years here, that is because it's annual, you have to talk in the number of periods, right? You have to think about it in the number of periods. In period 2, you get another 20 rupee coupon. Plus, because you have held this bond until it matures, you get 100 rupees back. These are your cash flows. Now, the difference here is we assume the coupons are reinvested at a rate of 4%. The coupons that we receive, this is like an individual's case, right? You take the coupons and you don't do anything with it. You reinvest it, you put it in your savings account. So an individual who purchased a bond takes the coupon and you put it in your savings account. So you generate a return of 4%, but you're not reinvesting it at 25%, right? To get a yield to maturity of 25%, you have to reinvest the coupon at 25%. But no, what do? You put your money in it, you get the coupon, and you'll either consume it or you put your money into a savings account. So here, let's assume that you put your money into a savings account and you have a 4%, you get a 4% return. So what do we do in a holding period return calculation? We look at how much is this coupon worth at the end of my evaluation period, right? So I'm evaluating the bond over these 2 years. The coupon I have received in year 1, at the end of my evaluation period in year 2, how much is this coupon worth? So you can see here, this coupon has been reinvested at 4% for one period. In this case, 1 year, technically one period, right? So 20 rupees reinvested at 4% for one period. So how much is your coupon worth at the end of that period? How much is this? 20.8. Yes. This coupon can't be reinvested because we are at the end of the period anyway, right? So this coupon is cash that I already have in my hands that I get at the end of the period. And I get 100 rupees face value at the end of the period. So those are all my cash flows at the end of the period. So at the end of the period now, my total cash flows are 100, not 120, but I have this 20 rupees as well. So it's actually 140.8. Not just this 20 has gained interest. So 140.8. So all my future cash flows are actually worth 140.8 in year 2. To get 140.8, because this is practically what would happen, right? When we buy the bond, we discount it to today's value and say, my future cash flows, I think are worth 92 rupees. Based on the fact that I am going to reinvest it at the same rate. So I paid 92 rupees to buy this. Okay. I paid 92 rupees to buy this. But when I think of the fact that once I get these cash flows, I reinvest it, actually all my future cash flows are worth 140.8 at the end of the period. Now, there are no in-between cash flows here. There are no in-between cash flows here. Why? Because all these cash flows were reinvested. So now the cash flows only occur at the end of the period, right? So this entire thing is zero. No in-between cash flows. So these are your two cash flows. You have one cash flow occurring in year 0, and you have another cash flow occurring in year 2, period 2. Right? And they're saying calculate the holding period return. Now I can calculate the non-annualized holding period return. Just for completion, let's calculate that as well. And I can calculate the annualized holding period return. Right? My non-annualized holding period return is simply, I have two cash flows. I have P2, I have P1. So what is my non-annualized holding period return? P2 divided by P1 minus 1, right? Which is 140.8 divided by 92.8 minus 1. How much is that? Fif- 46, 50, something like that. 51.72. Okay. So 51.72, thank you. It should be in percentage terms, guys, right? 51.72%. That makes sense, right? I purchased a bond at 90 rupees. Now I have 140 rupees at the end of the period. So I've made a 50% gain on my investment on a non-annualized basis. To annualize, I have to consider the compounding impact. So for ease, I will use straight away the equation. You can find the AER of this, you'll still get the same answer. So if I wanted to find the annualized holding period return, I'll use the equation future value equals present value 1 plus r to the power n. Okay? It's the same equation, we're just using compounding. So 59, Niraj is correct. Your future value is 140.8. Present value is 92.8. 1 plus r is what we're trying to find. To the power n is 2 periods, not 2 years, 2 periods, right? And we get r is equals to, I am told, 23.176. Thank you. Okay. 2 things you should see in this. So what is your holding period return annualized? 23.176. Okay. You were promised a return of 25%. But do you see you didn't get a return of 25% because you didn't go and reinvest your money at 25%. This coupon is 20. If you had reinvested at 25%, you can calculate and see you would have got a total return of 25%. But because you didn't do that, you went and invested this coupon at 4%, your actual return came down. But it wasn't too bad, right? You're still getting something close to 25%. Right? In the grand scheme of things, even though you reinvested your coupon at 4%, you're still getting something close to 25%, 25% down to 23%. Right? So in that sense, the impact, just because you reinvested your coupon at 4% is not too bad. But there are two things to consider here. This is only a 2-year bond, a 2-year period that you're considering, right? So you're only reinvesting one coupon at 4%. If you took a 10-year bond and you reinvested 9 different coupons at 4%, then the impact to you would be very high. Okay. So here the impact is not too bad just because it's a 2-year bond and the coupon is reinvested at this very low rate for only 1 year. But you can see even with that very low rate for only 1 year, there's still like a nearly 2% impact on your return. So to calculate R, use that to calculate R. And remember, R is you had to calculate R based on the number of periods. Now, here we didn't make any adjustments because this is annual compounding. But you would have to make an adjustment to R once you have semi-annual compounding, quarterly compounding, monthly compounding. You'll have to make an adjustment, right? Let's try this example. Calculate annualized and non-annualized holding period returns. Right.
Ma'am, what's the reason for taking the coupon out and reinvesting at a lower price?
You're not taking the coupon out, right? Somebody's paying you the coupon. What do you do with that coupon? That's the question. So, like the issuer is paying you a coupon. Like if it's a government bond, the central bank on behalf of the government is paying you the coupon. So it's not that you're taking the coupon out. What do you actually do with that coupon? Now, 2 years ago, when I invested in a bond like that, promising me a 25% return, today the government pays me the coupon, the 20% coupon, because there are actual bonds in the market that people purchased at 25% last year. And today, when the coupon comes, this 20% coupon comes to me, where can I invest it? I don't have another investment that's at 25%. Today, I have to look around at where my investment opportunities are. Here, I took an extreme example where most individuals will put it in a savings account. But actuality, I have to look at what my investment opportunities are. And based on those investment opportunities, I have to reinvest it. Right? So what's the first thing you have to do in this sum? What don't you have? Does the bond mature? Are you doing it for 10 years? What is your holding period? For how long are you calculating?
1.5.
1.5 years, right? Yes. So if you're calculating for 1.5 years, what's the first thing that you have to figure out?
Sales price.
Yes. What's your selling price? That's the first thing that you need to figure out. At what price did you sell this bond? So what is the sales price of this bond? Okay, I'm done. I'm waiting for confirmation by somebody else. Anybody else? What's the sales price? Yes, I think there's something wrong there. See, interest rates have come down, right? You purchased it at 90, so your sales price has to be higher because interest rates have come down. $28 doesn't seem to be correct. I don't have a verification yet, but it doesn't look correct. Not possible. I have three different answers for the sales price now. So what is confusing you all? Because this shouldn't take this long to find the sales price. What is confusing you all? Okay, Loving. I still haven't got a consensus answer. But let's look at the inputs. How much is, so you have N, R, C, face value is 100, right? What is N here? N is not 3. How is N 3? How do you say N is? Why is, okay, that is not correct because what is the price of a bond? What is the price of a bond? It's the present value of its future cash flows. We do not care that 3 periods have gone by. We're trying to find the price of the bond, which is the present value of its future cash flows. Right? So what is it?
17.
17. Exact. So you originally had a 10-year bond originally, which paid 2 coupons each year. That's 20. Minus 1.5 years have gone by, right? So 70, NA 70, that's correct. What is R? So for the person, remember we did this same type of sum multiple times, right? When we did the bond valuation section, you can't let it go out of your head just because now we are in the yield section, right? We did it only 2 weeks ago. Always it's the present value of future cash flows. You always look at it not from the side of the seller, always look at it from the side of the buyer. It's the present value of future cash flows. What is R? So 28? No, not correct. What is your input to the equation? That's what I'm asking.
6.
6. That's correct. So R is 12%, yes, but 12% for the year. These are semi-annual periods. So what is the R that we are going to input? It's 6%. The equation, it's 6%. Semi-annual R. What is C? Correct. C is 11, not 11%. It is 11, right? So C is, it's not the coupon rate, it is the coupon. 22% into 100 divided by 2. So coupon is 11. Okay. Now you can use this to calculate the price. How much is that? Very disappointing, guys. Like, this is something we did literally 1 week ago, right? How much is it? How much is this? Okay. So you see 152.38. So he purchased a bond at, how much did he purchase it at? 90. But when he purchased it, it was 2 years ago, right? He purchased a 22% semi-annual coupon bond at 90. You have to understand, when you purchase a 22% coupon at a discount, your yield to maturity has to be even higher than that, right? And now you're selling it, and interest rates have come down to 12%. So your interest rates have come down more than 10%. So obviously, here you're making like near over a 60-70% gain by the fact that interest rates have come down. Okay. So now you're selling it at 152, 1.5 years later. Now you can draw the cash flow diagram. You purchased it at 90. Over this 1.5 year period, that means over these 3 periods, what are your cash flows? You have a 90 negative. You get a coupon of 11 rupees in the first year, 11 rupees in the second year, and 11 rupees in the third year. Plus you sold it at 152.3863. These are your cash flows. So that's the first step. You draw your cash flow diagram, right? Second step, calculate the value of the coupons at the end of the period after reinvesting it. So now you have these coupons that you have received, and it says coupons are reinvested each semi-annual period at a rate of 8% compounded semi-annually. Okay. So what happens to the first coupon? What happens to the first coupon? How does it work? First coupon will be invested for how many periods? This first, yes. This first coupon will be invested for each semi-annual period 2 times. At what rate? 8% per annum compounded semi-annually. So that means 4% each period, right? So how much will your coupon be worth at the end of the 2 periods? 11 rupees into 1 plus 4% compounded 2 times. That is the first 11 rupees. What about the second 11 rupees? How much will this be worth at the end of the period? 11 rupees compounded at 4% once. Then you have another 11 rupees, but that's not going to be compounded because that's anyway at the end of the period. And then you have 152 rupees. So what are your cash flows at the end of the period now? $186,724.1. Is that correct? If somebody could verify. And at the beginning of the period, your cash flows are 9. So can you calculate your non-annualized holding period return and your annualized holding period return? Can somebody verify 186,724.1? Is that correct? Okay, I have two answers that say 186,7,239. Let's see, the third decimal place, that's fine. 7,239. Okay. Go ahead. What is your non-annualized holding period return and what is your annualized holding period return? In percentage terms, it's correct, but in percentage terms. Because it is not 2%, right? Okay. I'm waiting for a confirmation, Iraj. Okay. 28, is that annualized or non-annualized? Non-annualized, is it? No, that's right. So, Niraj, I think there is a -1. Did you take that into consideration? Arindo, right? Correct. So the non-annualized returns are correct. Yes. 107.471, right? How do you get that? It's simply your non-annualized return is P2 divided by P1 minus 1. So you have made a 107.471% return, right? Over 100% return by investing in this bond, right? Which is the type of returns people saw last year. If they took the risk in terms of the DDR, you don't know whether the DDR was going to happen or not. You took that risk. This was the type of returns that people earned. People could have earned, and some people did earn. This is the non-annualized return, though, because this is over a 1.5-year period. Now we want to annualize it. So how do we annualize it? What is your annualized return? 59. It looks a little on the low side. I feel that it's not correct. put it to the equation. And remember, when you're putting it to the equation, you have to consider the number of periods, and R is for the period. Are you taking that into account? R is for the period, right? So then you have to annualize the R. Okay. Right, let's wait for the other answers. Again, Tirani, what you're finding is your periodic R. What is your annual R? So you use this equation. Only thing that you have to be careful of is what is N, what is R. N is the number of periods. What is R? What is R? R is also the return for the period, right? If N is the number of periods, how much is N in this example? 28? No. How much is N in this example? Johan, no. 28, no. Yes, correct. 55, 37. Tirani, yes. N is 3. Remember the difference. Here you're looking at the holding period. And you're trying to figure out within this period, see future value and present value. The present value starts at year 0. Future value ends at, not here, period 3. Right? Present value starts at period 0. Future value ends at period 3. Don't get that confused with how we calculated the selling price. Selling price depends on the buyer, not the seller. So the buyer purchased it at year 0 for him, and he had 17 more periods to go. That's the future after this point, right? For the buyer, he was going from this point forwards. But for the seller, he is evaluating what happened. He purchased this at 90, he held it for 3 periods and sold it at 152. So N is 3. 3 6-month periods, right? What is R? So FV is easy enough. We know that this is 186.7239. Present value is 90. 1 plus R to the power 3 periods. So you all are getting R to be I saw that several of you got the correct answer. 27.54. But is this the final answer? 27.54 is not the correct, it's not the final answer. Why? That's why I asked, what is R? What is R? What is the definition of R? Return for the period. What is the period here? Yes. This is the 6-month R. So therefore, what is R? What is your holding period return? $27.54 is for 6 months or 1 year. It is 55.08. So you have made an annualized return of 55%, or over the period, you've made 107% return. Over the 1.5 years, you've made 107% return. Yes. Which is why in this equation, do you see? See, I told you this right at the beginning also when I showed you this equation. Do you see this? Right? If you use this equation, then R is annual. Right? If you use this, then R is annual.
Excuse me, Vidya. R, don't you just multiply it by 2? You don't compound it?
You don't compound it. You don't compound it because, see, all of these have been given to you as compounded semi-annually. See? So to be comparable, 55% is also a compounded semi-annual return. That's the reason. It's for comparability purposes. Right? If you compound it, then what you get is the AER, the effective annual rate. Both answers are correct. There's nothing wrong with the answer. For comparability purposes, the correct way to do it is not to compound it, but because, see, when you say you purchased a bond, a 22% semi-annual coupon bond, that is a compounded semi-annually return. When you look at the YTM of that return, 25% or 24% YTM, that's also a compounded semi-annual, right? YTM is also compounded semi. When you say yield to maturity is 12%, this is also compounded semi-annual. So this is also compounded semi-annual. So just for comparison purposes, the holding period return coupons are reinvested at 8% compounded semi-annual. So if I find my AER, on comparison terms, it doesn't make sense, but it is not incorrect. It's okay. Right? It's not incorrect. It's just that for comparison purposes, the best one to use is always the comparable return, which is the one that is compounded at the same periodic rate as all the other returns in that sum. That's all.
Thank you.
But see, you won't be penalized for that as long as it's AER and you understand it's AER and you write it that it is the AER, you will not be penalized, right? But if you're using the AER, you should identify that what you have computed is that. Other questions? So when you're using this equation, remember, when we put the FV and PV and we said we put 3 here, what were we doing? we were saying 1.5 periods into 2, right? Frequency was 2. Same way, if I want the annual R, then I have to divide it by the frequency. Otherwise, if you just use R, if you just use FV equals PV 1 plus R to the power N, and for N you use the number of periods, and for R you don't make an adjustment, then what you're getting is the periodic R. So then you have to separately multiply it by the number of periods to get the final answer. Otherwise, you can straight away use it through the equation and get the final, and then the answer will be the final answer, right? Any questions here? Okay. Right. So this is fairly straightforward. You all can try this on your own even. Just read through it. We don't need to try it, but just read through it and see if there are any questions. So the any bond example we've been doing now the past, we did about 2 other parts of the any bond, right? See if you know what inputs you have to put and any confusions that you have. Forget the yield to maturity. Just tell me what the nominal yield and current yield are. Yep, that's right, Niraj. Right. Well, for current yield, I have two different answers from the previous answer and your answer. Nominal yield is okay. So what is the what? Okay, Ravindu. So 59, I think your current yield is not correct. So what is your nominal yield? Very easy, right? It's asking for the nominal yield, current yield, and yield to maturity. Yield to maturity, you can calculate it at your leisure. As long as you know what the inputs are. I mean, it's basically you can calculate it, right? But to figure out the inputs, what is nominal yield? So you have a bond, face value is 1,000, coupon is annual 3.75%. And at the time of issue, it's 3.75% anyway. It's only if any doesn't reach its sustainability targets that the coupon will increase by 2.5%. So at the time of issue, the coupon that's paid is 3.75%. And offer price, the price that this bond starts trading at is 95.85% of face value, right? This is the starting price. So what is the price of this bond at the time of the IPO, at the time that it is issued? It is 95.85% of 100, which is 958.5. So based on this, nominal yield, we don't have to do any calculations. Nominal yield is equal to the coupon rate, which is equal to 3.75. No calculations required, right? Percent. Current yield, that's correct, 28.59, right? Current yield is coupon of 37.5 divided by price of 958.5. It comes to 3.91, right? 3.91%. So that's your nominal yield and current yield. When you want to do your yield to maturity, what will be your guess? One. Your guess will be 100 or 1,000 actually, minus 958.5 per annum divided by what? Divided by how many years? To annualize this, divided by how many years? Yeah,
7.
7. That's correct. If the bond is issued in 2021, it matures in 2028, right? So it's divided by 7 years. Based on that, you can find your guess 1, and then you can find P1 and guess 2, P2, and figure out what your yield to maturity is. Okay. So here it's annual bond, so it's very easy. There are no confusions. But when it's semi-annual, quarterly, you have to make sure that you remain, that everything is comparable, right? That's the main thing to figure out. Any questions? Okay. So before we stop, let me just go through one thing. Second. So in your assignment, I just want to make a small note here. In your assignment, small changes that are going to happen because I'm not in for the next couple of weeks, right? Your bills and repo going forward, this is actually it's a 7-day return, but it was 6 days here just because it was a holiday, remember? So because of that only, it's a 7-day, it's actually a 7-day return. Otherwise, your repurchase rate was 6 days for this week as of 28th March, just because it was a short week, right? So it was up to Thursday. But this return will not be given to you. You will have to take it from your file, right? So from your new report, when you take this file as at the reporting date 28th March, which is the file that you need to take. Okay. This file, right? Date of reporting 28th March. Here, for the weekly repo rate that you will use for your cash transactions, you we'll have to use now. Here you use the quoted treasury bond rate, right? For bonds. For bills, you use these rates. When you go to new format, right? Not summary statistics. When you go to new format, here you will see sorry, the overnight rate, 7-day rate, reverse repo rate, right? Of this is the rate that's relevant to you for your weekly rate, right? So your repurchase 7-day rate is 8.82, which is the rate that would have been published here in your assignment, right? Going forward, this rate will not be published. It will be, you will have to take that rate. I will just write here, take it from the CBSL report, right? So you will have to go to the report in under new format. You see the 7-day rate that's published. You don't use the reverse repo rate. And anyway, we are not using the overnight rate because you're assuming that your money is going to be put into a repo for 7 days, right? Invested for 7 days until you need to utilize the money again. So that rate you have to use from the report itself, okay? Because there are, okay. That is one thing. And this part also will not be published. So now you know how to get the closing price. You'll have to take it from the CSE daily. You go to the CSE site, right? Go to market, go to the CSE daily, and you find the right report, right? So on 28th March, that was the report that we were looking for. I'm saying this, and then you go to, you don't use these share prices and trades, right? Here you see the same share has been reported multiple times. Why is that? This is every single trade that happened in the market. This is not the point that you want. You want the point where it starts reporting from pink, right? The first page that it starts reporting in pink talks to you about the industry statistics. That's not what you want. You want the share statistics, right? The daily share statistics where the closing prices are available, and that's what you will start to use. This is because I'm not available for the next couple of weeks. So because of that, I can't put out this report and tell you to use these data. Okay, so which is why that those two will change for the next couple of weeks. You'll have to use, anyway, this going forward, you will be using the repurchase rate based on directly from your central bank file. And this I will stop because for the 2 weeks, I will not be able to publish that, right? So I will not be able to change the page numbers or anything, so that line will go off. Everything else will be there. You will get your normal data file over the weeks, and and if you're changing any data, meaning you're buying new securities, selling new securities, selling old securities, right? Making any changes to the file based on buying and selling, then you have to submit the assignment, the in-between assignment before the what do you call it, deadline that has been assigned, which is usually the next Tuesday. Right? Next Tuesday is so this week 2 file that I sent, the deadline is this Tuesday, which is the 9th. And then when I send the file again, the week 3 file, deadline will be next Tuesday, like this. The Tuesdays will be your deadline to submit the new portfolio, right? That is that week's portfolio if you have made any changes. And changes means purchases and sales. Any questions here? Okay. So I am only back from the beginning of May. I won't be here for the next 2 weeks. Anyway, next week is Auridu. I mean the 2 weeks after Auridu. I will not be here. but the weekly data files will continue to be published. And when publishing the weekly data files, again, one thing that will usually it will get published on this, right, on the assignment, but for the 5th data file also, it will get published somewhere here, right? It will get published somewhere here. So it will essentially say that the week 5 data file or week 4 data file, I can't remember which one, it won't be uploaded in the assignment folder. It will be published somewhere here, right? So check for that below, not under the assignments folder. That's because I'm not available. So it's a little bit, I have to make a bit of concessions here. That's why, so that data file per se, check below when you're looking at your data. That's it from me. Yeah, any questions? Okay, so we can start. Thank you.
Thank you.
Thank you, madam.
Thank you, madam.
Bye.
Thank you, madam.
Thanks.
Thank you. Thank you.